describe my experience in particularly the last year and a half with the holdings that I've had, and with your help and guidance in the precious metals. Certainly, as we've gone through the volatility that we've seen in the last 18 months, and certainly even the last few weeks, I've looked at my precious metals portfolio and it stays relatively calm, notwithstanding the fact that has had a great run up over the last 12, 15 months in terms of the inflation hedge aspect. So that's been a wonderful premium. But even amidst the volatility we've seen in the different asset classes, the precious metals have remained very, very, very stable. And again, we can only predict, and I know you would probably say that besides being a good insurance hedge, it's a place for risk off asset deployment in a period where investors say, well, I don't want to just sit all in cash or treasuries, but I'd like to have something that maybe provides a little more upside. So again, some balance or allocation amongst that classification would be a prudent thing to do. And again, this is your forte, so I'll let you speak a little bit more to that.
Yeah, well, when you're constructing a portfolio with precious metals, there is a proper way to do it. If you want more than just a hedge, you could just buy, some gold kilo bars and call it good. If you're looking for just the hedge, and that's certainly what central banks are prone to do. It's a far more liquid market. They can come and go, buying tons at a time, millions of ounces at a time, and not move the market. If you tried to do that in silver, you would definitely move the market. If you tried to do that with platinum or palladium, it's not even possible with those latter two white metals. It's such a thin market. So if you want a growth component, you can capture ratios, the kind of the arbitrage between the metals, or even premiums, depending on where you purchase. Some products today carry no premium, but have a history of trading as high as 20 or 30% above their base metal value. And that allows you to compound ounces. So you don't necessarily have to see a move in the metals. If there's any change in the demand dynamics for those products, all of a sudden premiums are there. You can harvest those gains and capitalize on having more ounces. I think most people are stuck in sort of a 60-40 portfolio mix. They don't even think of precious metals. And when they do think alternatives, they don't think precious metals either. They think of the three categories we mentioned earlier. So the 60-40 portfolio, it has worked incredibly well in a period of declining interest rates, where your cost of capital is coming down, the value of your bonds, interest rates come down, bond prices go up, right? So you've got a winner there. And you've also got a winner in stocks, because as rates come down, what they call the hurdle rate, if you're looking at the capital asset pricing model, it allows for a revaluation of the company to a higher multiple. So interest rates drive gains and growth in stocks as well as bonds. So really, the reason why people look at 60-40 and say, or maybe you're getting older and it's the other way around, 40-60, less equities, more bonds. They say more bonds in a portfolio is safer, but safety has nothing to do with price volatility. Safety is really about what happens in the event of insolvency. And that's where you stand in the capital stack. If you're going through a bankruptcy, you're first in line as a creditor, you're last in line as an equity holder. And so there is a diversification and less risk in a bond, but that does not speak to the price volatility in the underlying asset, which is where you have to look at external factors to see what's driving interest rates and ultimately the value of those financial assets.
Yeah, no, very well said. What about the commodity cycle? Where do you see that today, and as opportunities for the future, and also part of a portfolio allocation?
Yeah, it's super idiosyncratic. Depends on what the commodity is. So, for instance, we've got to have GDP growth for many commodities to boom. If you're talking about iron ore, if you're talking about demand for concrete, if you're talking about demand for aluminum and steel, it really helps to be in sort of a demographic boom. And that's pretty hard to find these days. We had a massive boom and a huge commodity cycle coming through 2008, 2009, as we were watching China basically shift their economy from being predominantly agrarian to reinforcing their mercantile base and being sort of the exporter of all goods to the world. And so as they migrated folks from the farms into the cities, they were the primary source of demand for copper and iron ore and all of these basic industrial commodities. We don't have that kind of a commodity super cycle today. I think there is a boom in energy, which is in the early stages, and I think there is a boom in the metals, in part because you're seeing central banks and reserve asset managers allocate that direction, and also in part because as financial assets face the headwinds of higher interest rates, higher cost of capital, people start to look and diversify, and that creates a new source of demand, investor demand for the metals. But even within the energy space, it's idiosyncratic. Take, for instance, oil today. Oil, in some respects, is like diamonds. It's a controlled market. We are today the largest supplier of oil and natural gas, largest producer of oil in the world. The U.S. is. We've surpassed OPEC production, but we know that OPEC has at least another 3 or 4 million barrels per day that they can produce if they choose to. That's the similarity with De Beers. De Beers sits on this huge hoard of diamonds, and they trickle out what's necessary to sell some, but keep their margins healthy. They would never want to flood the market because then the price comes down. What we've seen in terms of price volatility with oil over the last few weeks, we know that in April, we've got OPEC bringing 130, 140,000 barrels per day back to the market. And they'd like to bring probably closer to 1 million barrels per day back to the market. So if demand is not sufficient to meet the new supply, prices are going to decrease. Where we've seen a positive increase, 22% year to date, is in natural gas, where, yes, we're a large producer, yes, we're a large exporter, and we have growing demand for reliable energy. Let's call it reliable energy. The push over the last decade and a half has been towards green energy, frankly, not reliable. And that's become problematic. You can't run solar in the UK. You can run a wind farm, but the wind farm is only as good as the windmills, as long as they last. And actually, when you look at the capital costs of putting those in place, maintaining them, and then replacing them, actually in pretty short order, the numbers don't work. They are renewable, they're clean, we feel better about them, but the math is terrible. So you go back to fossil fuels as a way of providing reliable and cheap energy. Natural gas is superior to coal in terms of its clean profile, and it is abundant. We happen to be sitting on the largest stores in the world, and so we're now beginning to export more and more through LNG channels. And so we see a bull market in natural gas. Ultimately, we see oil catching up, but on a different basis. So it is difficult to talk about a commodity super cycle without managing each individual category. It's one of the things we focus on in our asset management group is global natural resources. That is an expertise of ours, but it's a tough space to manage because every one of them has different supply and demand dynamics.